Hello, folks. Brendan Chapman with you today for TheoTRADE. It is April 15th, 2024. What a day. It's tax day. I hope you got your taxes in. I hope you got your extension filed, whatever you're choosing. But boy, today the market fell on its face a little bit. And so, at these kind of moments, it's so important to understand when to buy. When is the market bottoming? I'm going to give you 5 indicators that you can look at to help identify when the market's bottoming in the near term. It will help you buy when others are selling. So today the S&P finished down 1.3%. Well, why? Well, we've certainly seen the tenor of the market has been to be more sell side. And on Friday of last week, we saw some weakness, certainly precipitated by last week's inflation data, the working off the idea that we're going to cut rates this year or cut 3 times or 2 times. We're backing off some of that. And as a result, what's happening is the bond market is beginning to sell off as well. Sorry, TN changed the symbol on me. TNX colon CGI is the new symbol here for the 10-year. We're breaking 4.5%. We're en route to maybe 5% on the 10-year. Are we going to take off the table any rate cuts this year? Either scenario, long-term Treasury yields are rising. The Fed funds rates 5.25 to 5.5%. And we're seeing this worry or this building inflationary expectation. And certainly a lot of the news in terms of the weekend coming out, we're seeing certainly conflict in the Middle East. And this certainly has contributed to the rising oil prices. We tried to see a little selling today, but we were covered off of our lows. Today, gold, for example, again, saw some selling initially. We recovered off our lows, finished at the high. The inflationary kind of status of the market is causing waves or headwinds for the market going forward. We look at today's top performer. Obviously, Goldman Sachs had some excellent data. The trading side of the banking space has performed well. It's been the lending that's creating the drag. And we saw that with JP Morgan last week as it swooned following its earnings, despite beating on the top and bottom line. Again, the notion back here was, hey, we're going to get 6 rate cuts this year. Now we're looking at higher costs, weaker margins, less income off of net interest income. Again, all this stuff contributing to some of the weakness in the financials. And you look at today, for example, financials down 0.5%. In the last week, financials are down here, down 4.5%. In the last week, the second worst performing, along with a very inflation sensitive, or rather interest rate sensitive sector in real estate. And so we have this backdrop of rising yields, this backdrop of a potentially stronger dollar developing, in particular against the euro. So if we look at the euro / US dollar, we're breaking support here, dollar strengthening against the euro. But in real terms, it's actually weakening as gold prices are higher today versus Friday's close. And the dollar, generally speaking, last Friday was very strong and helped contribute to the market's weakness. And so the question becomes, the selling we're seeing right now is definitely welcomed. It's going to be healthy for the market to see selling. We've kind of talked about since the 21st the idea of reducing your exposure by taking profits and hedging. And I think it was a very timely point to consider doing that. And what triggered that point was to say it was the volatility markets, and that what they were telling us about what their expectations were in the market. And it doesn't mean that it's always correct. I did the same thing back here on December 14th, right here. We talked about taking profits and hedging. Well, if we look at small caps in December 14th of last year, it was right here. It was a pretty good time, generally speaking, to take profits and hedge. And right now, in dollar terms, we're trading below that level. For the S&P 500, we took a hiatus for several weeks before we finally broke out again and began running as the dollar weakness propelled stocks higher. Now we're turning the corner. We're seeing dollar strength, and now we're seeing the air come out of the balloon, which is necessary. We were 13% above the 200-day moving average at its peak up here in the 21st. This is a great time for the market to start to consolidate or pull back and reconnect with those longer-term moving averages, the 50, the 200-day in particular, and start to create better opportunity. Now, here in the near term, today was a pretty significant selling day. We're down about 1.3%. We finished near the lows of the session during the cash session. Is this the time to consider to start buying right now? Because we may see that the market, maybe it starts to consolidate here as it converges with the 50 and 200. Maybe we rally off this and we continue to detrend away from the 50 and 200. The issue is we just don't know which it's going to be. As traders, we have to make judgment calls as to when to start to add risk. This was a very definable point to say, hey, time to take profits, reduce exposure, and hedge. Now is it the time to look at going long the market and finding bullish opportunities? That's what we're going to examine today in today's video. We're going to look at 5 key indicators for that. The first key indicator, market's got to sell, right? We have to see selling before we're going to see buying to create that risk reward setup that's very beneficial for beginning to go long the market. Well, if we look down, we're down about 640 today on the SPY. We want to relate that in terms of historical norms. So we're going to look at the ATR study. So we're going to go over here to the ATR. We're going to bring that in here. And we're going to see what is the average true range for the SPY. The average true range takes the difference between high and low, or from the previous day's close to the next day's high or low, whichever is greater. We're accounting for gaps, which for the SPY, it's only open during the cash market. So as a function, there's gaps overnight frequently. Notice the ATR, if we look down here towards the bottom, is $5.85. Okay, we'll look at today's move. We're down $6.40. So we had greater than 1 ATR in terms of the selling today. That is our first indicator. So based on today's selling, we outpace what you would expect. And as a function, this is a point that checks the box. Yes, we were down greater than 1 ATR. The second box involves the VIX. The VIX, we're looking for a big move. Why does the VIX go higher when the market sells off? Because what happens is they step in and buy puts, okay? It's the put option buying, the imbalance of buying options, specifically buying puts, that causes the VIX to rise. And so at these points, when the VIX gets a big move, it helps identify potential market bottoms. If we look back over the last year, this 19 to 22 range was an area frequently where the VIX peaked. And when the VIX peaks, generally speaking, that's when the market troughs. There's almost a one-to-one kind of inverse relationship between the VIX and the S&P 500. So the big move that we had today, closing at 19.23, certainly looks big, but we can apply an indicator. I'm going to bring up the Keltner, I have a Keltner trend study set. It's just a Keltner channel with 2 ATR and 20 days. Notice today we closed above the 20-day Keltner channel for the first time since April 4th. That is our second trigger. So again, we're down greater than 1 ATR. The VIX is above the Keltner channel, the 20 and 2. This is another signal saying, hey, the VIX is high. Now we're looking at volatility expectations. Certainly the VIX can go higher. The VIX is not as range bound as other indicators. So as a function, what we're going to bring up here is what's called a ratio of 3-month to 30-day volatility. So I'm going to bring up the VIX 3M plus VIX. By looking at this ratio, we're saying we're looking at 3-month volatility and we're dividing it by 1 month. Ideally speaking, if this is going to be a low, we want to see this value over here. We're not concerned about the plus sign here. We're not concerned about the candles. We want the ratio. And the ratio finished today about 1.01. Did not quite finish below that trigger at the 1 level. If we look at this intraday, were we below 1 at some point? Yeah, we were right here intraday at about 11:30 my time, Mountain Time. We did see this threshold kind of get down to that 1 level. We, however, did not close below it. This ratio is really a proxy for what's going on in the VIX future market. But this is the third criteria. We'd want to see this close below 1. This is not met today. We didn't see that 30-day volatility rose enough to really eclipse the 3-month volatility by 20%. Let's go to our fourth criteria. This is kind of a proxy for this next one. We're going to look at the VX futures. What we're going to look at here is the structure. Are we rising or are we falling? Are we rising being a normal or a contango market? Or are prices falling, in which case it's a backwardation market? Notice that prices are rising as we move from one contract to the next. We're not yet in what's called backwardation. Backwardation is where these contracts are falling in price. What this reflects is that the market's expecting the VIX to fall out into the future. This is a bullish condition. Now, if we look at the current volatility, this is our fifth criteria here. We want to see that the two contracts, May and June, that make up the 30-day expected move, we can see that we want to see that the VIX is above these levels. If we're just take just a straight average, even a 30-day weighted average, this is currently at about 18.1. That's at 18.25. We're basically looking around 18.15. Well, let's compare that to the spot VIX today. We already saw that the VIX is at 19.23. So right now the VIX is pricing above the VIX futures, which is an indication of a potential bottom. So let's review these 5 indications. Number 1, we want to see that the SPX is down greater than 1 ATR. Check, we got that one. Number 2, we want to see that the VIX is greater than the 2 ATR 20-day Keltner. Do we have that scenario? Yes, we do. The third scenario we want to see is that we want to see the ratio of 3-month volatility plus divided by the VIX. We want to see that is less than 1, meaning that the VIX is higher than the 3-month vol. Number 4, we want to see that the VX futures are in backwardation. Okay, that means the prices are falling and indicating there's an expectation that volatility will fall in the future. Number 5, we want to see that the VX, /VX is less than the VIX. Okay, that triggered. So if we go through these lists of criteria here, number 1 triggered, number 2 triggered, and number 5 triggered. We're still waiting to see what's happening with this 0.3 and 4. We're not seeing the VIX tip in backwardation, nor the 3-month dip below the spot VIX. We're still above 1 at the moment. So we may see that happen tomorrow. So right now we'd suggest, you know what? We're not quite at that capitulative phase. Now I'm going to throw out a bonus 2 other criteria here. Another criteria to look at is the skew index. Right? We saw on Friday with the selling, the skew index actually rose, which is highly unusual. Skew rises when we see buying puts and selling calls. So yes, the VIX rose on Friday and selling calls. But what we saw is that there was kind of there was enough call selling that we saw the slope of volatility as we go across strike prices got steeper from where it was the previous day. So we're seeing the skew steepen going this way. Let me do it again. So if we're like this, the skew begins to steepen as things turn like this. We see put implied volatility shift up, call volatility shifting down relative to put, but overall shifting up with the rise in volatility. This is an unusual circumstance. We'll see here probably shortly, usually about an hour after market close, you'll see a new skew print for today. If we see this rise again, watch out, we have more selling to go. If the skew begins to really fall out, the bottom falls out of it, and we start to see skew get down to 115, 120, this creates an excellent opportunity to really start to look to go long as we're starting to crack open the upside in terms of a much bigger volatility range to the upside. So we won't get this until later today. It's not on the video right now. Watch for this. If this starts to dip down here again, that would be another indication of a market bottom and a much more durable bottom. The last time we were down here, we'd have to go back, a little while to the end of 2022 before we saw the rally in 23 into 24. If we were to get back down here again with a higher VIX, this creates a very strong opportunity to start to get along the market. So case in point for today, the triggers are not entirely met. It doesn't mean the market can't rally for a few days. What you want to identify as an opportunity to consider to start to get more long, and it just looks like we're not quite there yet. Tomorrow might be the day. Now, if we see further selling in the market, we may see a higher VIX that gets closer to 22. How do you want to get long in the market? This is a point where you start to look at potentially selling premium. And if the VIX starts to, if the skew starts to come down, this could open up an opportunity to sell some put verticals. Or at TheoTRADE, we have our Ultima strategy. This may crack open the opportunity to start to sell some puts or strangles and buy that downside hedge and capitalize on the higher VIX. So that's one of the first points if you're looking to get long the market is through premium selling as the VIX gets peaked here. And what a better indication of a peak in the VIX when we start to look at forward volatility, that 3-month to 1 VIX ratio, looking at the VIX term structure, backwardation, expecting volatility to fall. Those are some of your key indicators we've yet to trigger yet, but may likely happen tomorrow, may create a near-term opportunity to sell some premium as we may get a rally in the coming days here. Anyway, folks, that's the video for today. Hope you find it helpful at identifying to start to go long, buy when people are selling, other traders are selling, and those are your key indicators that work fairly well in rare exception when you get those 20, 30% bigger pullbacks or corrections or bear market scenarios. And we'll catch you back in the video next week. Thank you.